It's amazing to me to watch the ETF business keep growing here. We follow the quarterly and first half numbers here. Doug Jonas over at the NYSE put out his first half numbers here. 2,639 ETFs, $4.3 trillion in assets under management. And he says 2020 is the year of active management. And we have 56 actively managed ETFs that have come to market this year. That's nearly half of all the launches. I've never seen that before. And of course, Ark Invest, you're sort of the leader in the active space, at least active equity space. Is it too much to say you're the success story in active equity management this year? That Ark Innovation ETF you've got, ARKK, it's nearly $6 billion in assets. What do you attribute the success here? Is it you guys are a bunch of geniuses, you and Kathy Woods over there, or is this the year for active management, or is it the right kind of selection? Why are you particularly successful versus everybody else?
Hi, Bob. It's great to speak with you. We've had record-breaking inflows into our actively managed ETFs so far this year, and Ark now has 40% market share of all the actively managed equity ETFs, which suggests that investors want more than just active management. They want exposure to innovation. And as you know, Bob, we're focused on 5 innovation platforms: DNA sequencing, robotics, energy storage, artificial intelligence, and blockchain technology, all of which we believe will create multi-trillion-dollar opportunities over the next 10 to 15 years. And these disruptive technologies are experiencing an acceleration in adoption in this current environment. And the companies within our ETFs are gaining significant market share and outperforming the broader market. So the disruption that's caused by these innovative companies like Tesla and Square are making it critical for investors to allocate to innovation in their portfolios. And we see this is just the beginning of this trend.
But it's no secret, Renato, that the reason Ark has been, the ARKK, your innovation ETF, has been so successful this year is you have a really big bet on Tesla. It's, 10% of the fund, essentially? You have very concentrated bets. So the question is this. Number one, you made the right guess on Tesla. Had you not, you wouldn't have been up nearly as much. But I think on a broader question, do you think investors want these kinds of concentrated bets? It seems like they actually do. There you see, look, there's 10% on Tesla, and Invitae and Square and CRISPR and Roku are very significant holdings as well. But this is a pretty concentrated portfolio. Is that what investors want? Reggie, let me ask you, do you get this sense of active management that they'll be successful if they make these kinds of concentrated bets and they live and die on whether they're right or not? Reggie?
Well, I think there's always a room for active management, particularly in an ETF format. You look at all the non-transparent ETFs that are brought to the marketplace recently. I think there's 6 of them, or 5 or 6. I think they're picking up speed. There's always room for active management, and particularly when markets reverse, and I think you start seeing the views of the active manager present alpha, I think you'll see a difference between active and passive. So just because ETFs are here does not mean that active goes away.
Yeah. But Harry, we get back to this old question. I know this is a little older than you and me, but is there really any evidence that active management outperforms passive management? I don't see it. Certainly not in the long run. Vanguard was practically founded on this idea that it can't be done. It's wonderful that Kathy and Renato are doing so well over at Ark on a concentrated bet, but they are a very small group of winners there. Harry?
Yeah, very true, Bob. It's the story has been for years how passive has outperformed active. And I like the Ark story. I've been following it for years. And I think others are going to come, and they're also following Ark. I know as a market maker, we get asked a lot of questions by existing issuers and new issuers, and they're all talking about Ark and what they're doing. And I think you're going to see more active managers come, and we're going to get to see. We're going to see if they really can do it going head to head. They've been shying away from the ETF platforms.
Right. And so the secret here, Renato, is really you have hit upon the right methodology for the times. Disruptive technologies that are altering the way we work. We now have a pandemic that is accelerating the way we work, that are benefiting the specific stocks that we had talked about as just what we broadly call disruptive technologies. So you're picking stuff in a growth area with a lot of disruption that's changing the way we work and live. I guess that makes a lot of sense. If you were working in another space, defensive or industrials, it might be a little harder to do that kind of outperformance that you're seeing here with your funds right now. Or is that a fair way to characterize this, Renato?
Yes, absolutely. I mean, we're focused on these transformational technologies that are disrupting and disintermediating existing sectors and industries that make up some of the ones that you just mentioned. And they dominate these broader-based indices like the S&P 500. And most investors have exposure to, those broader-based indices. So this is providing kind of your forward-looking exposure. The names, we have zero FANG exposure right now in our portfolio. These are the next group of FANG stocks we believe that will be part of the broader base indices. And it also serves as kind of a hedge against the potential disruption happening in those core portfolios.
Yeah. The other thing I note is you really are a little unusual in that you're the far and away the largest actively managed equity ETF. I guess the question here, and anybody can handle this, why is there so much more active management? We have ETFs like Mint out there, and the JP Morgan one's pretty big. But why is there so many more active managed bond ETFs than stock ETFs? Is that about to change dramatically this year? Is it just harder to pick stocks than it is to pick bonds? Reggie, you want to take a shot at that? Go ahead, anybody.
Yeah, this is Renato. I'll comment on the non-transparent active ETFs. That's where we're seeing a big push on the equity side. And, we're fully transparent, but we think that asset managers that are coming on board and bringing those ETFs to market are actually educating the market on how investors can buy these actively managed strategies in a more kind of tax efficient and lower cost wrapper compared to mutual funds. So we think this will help accelerate kind of the transition away from active mutual funds to active ETFs.
Well, Bob, if I can jump in, I think investors just would like to just have the opportunity to pick the vehicle of choice, and the managers are going to deliver their views, whether it's for a 40 Act open-ended mutual fund or an ETF. Investors will have the choice vehicle to utilize. So I think that you always have the room to bring active management equity into the marketplace, and then that's what's been traditionally. ETFs are just catching up to it from equity standpoint. So I think you'll see a lot of growth in the active equity space utilizing either a transparent vehicle to deliver those views or a non-transparent view over the next, call it, 18 months or so.
Yeah. Harry, you're going to have the last word here. I gather you too feel that active equity is finally here to stay. I guess the problem I have is very simple. If you're a mediocre active manager in a mutual fund wrapper, you're not suddenly going to become a genius by suddenly throwing it into an ETF wrapper. You may charge lower fees. You may have a more tax-efficient structure. Even if it's non-transparent, though, it's not going to turn you into some kind of genius. That's my concern. Ark would be successful in a mutual fund platform because of the space that they're in and perhaps their methodology. But would you agree, Harry, that just switching to an active non-transparent ETF wrapper isn't going to change anybody's track record?
You're dead on, Bob. It's whether it's active non-transparent or active transparent, you still have to perform. And if you're going to be active, you're going to have to pick the right stocks. You're going to have to trade them properly. And that's the big difference. So as I said before, if they're going to come out with an ETF and they think they can do better in an ETF wrapper, well, they're still going to have to prove it. And it'll be great to watch, and it's going to be good for the ETF industry because more and more people are going to get into it, and it's going to be a lot more visible.
Yeah, I agree with that, Harry.